If you're marking supply and demand zones just because price touched a level multiple times, then you're not trading with logic, you're just guessing. And the market loves traders who guess. But today, we fix that. Welcome to the Supply and Demand Zones Mastery class, where you finally learn why a zone works, not just where it is. In this video, I'm going to break down supply and demand the way institutions actually use it. No indicators, no guessing, just pure price action logic. And make sure you watch till the end, because I'll reveal the 3 biggest mistakes traders make while drawing zones, the secret to improve your zone validation, and most important, how to avoid fake zones on any time frame. So grab your chart, stay focused, and let's decode how real smart money marks supply and demand. Before we start marking zones, let's get one thing 100% clear. What actually is a supply zone, and what actually is a demand zone? A supply zone is an area where aggressive selling started from, and a demand zone is where aggressive buying started from. These zones exist because institutions never get all their orders filled in one move. So when price returns to that area, the unfilled orders push price again. Now, before we start drawing real supply and demand zones, let's fix the biggest mistakes beginners make. Because if your foundation is wrong, every trade you take will feel like gambling. Mistake 1. Marking every candle as a zone. Most beginners think every sharp candle or small rejection is a demand or supply zone. But a zone is not just a candle. It's the area where institutional orders were placed. If there's no strong displacement, no imbalance, and no follow-through, it's not a zone. It's just noise. Mistake 2. Trading a zone without confirmation. Just because price touched a zone doesn't mean it will react again. Zones are not entry signals. They are areas of interest. Professional traders wait for confirmation. Structure break, candle shift, or liquidity sweep first, then they enter. Mistake 3. Ignoring higher time frame context. A zone on the 5-minute chart is useless if the higher time frame is moving in the opposite direction. Supply and demand always work better when aligned with the bigger picture. So now the real question is, how do you mark a zone perfectly, and when is the right time to trade it? That's exactly what we're going to break down next, step by step. All right, let's start with the supply zone. Before you ever mark a zone on the chart, you need to understand why that zone exists, not just where it is. Because most beginners simply draw a box wherever they see price touching a level 3 to 4 times, and then they call it a supply zone. But that's not supply. That's just guessing. Real supply is created when big money sells aggressively, and the chart shows proof of that move. So here's the first thing you look for. A strong, aggressive move down, not a slow retracement. When the market falls with big candles, back to back, that move tells you institutions placed heavy sell orders. Now go 1 candle back. The last bullish candle right before that aggressive drop. That is the origin of supply. That candle is not random. That candle is where smart money filled their sell orders. And that is the candle we use to mark the zone. So what do we mark? We take the high of that last bullish candle and the low of the same candle. And that becomes our supply zone. You can draw it wick to body or body to wick, depending on your style. But the idea is simple. We're marking the exact price range where the sellers entered the market. But the zone is not valid until the market breaks structure. If price drops from the zone but does not break a previous higher low, that means the move was weak, no institutional power behind it. So every time you mark a supply zone, ask yourself, did this drop break structure? If yes, the zone is valid. If not, ignore it. Now listen carefully. This is where most traders lose money. You do not sell during the drop. You wait for price to return to the zone, because that's when the unfilled orders get triggered again. So once price revisits the zone, then we look for confirmation, rejection wick, bearish engulfing, imbalance fill, whatever your confirmation model is. Stop loss goes above the zone. Target, the previous low, the imbalance below, or a 1 to 3 to 1 to 5 risk reward depending on volatility. A strong supply zone creates an explosive drop. Clean candles, no hesitation. A weak zone forms when candles are small, choppy, or the level is retested too many times. The more times price touches the zone, the weaker it becomes. Institutional zones don't give multiple chances. They hit once, maybe twice, and then disappear. So now you understand how to identify a real supply zone, the logic, the formation, and the right way to enter. Now that you clearly understand supply, once you learn both sides, you'll finally be able to trade with logic instead of luck. Before we move ahead, let me ask you something. What if the market already formed one valid supply zone, but later it creates another impulsive move and forms a new one above it? Should you still trade the old zone or the new one? The correct answer is yes. You can mark the new zone, but only if it follows all the same rules: impulsive move, clear origin candle, break of structure, and a strong rejection when price returns. Look here, this first zone worked perfectly. Price came back, tapped the zone, and dropped sharply. But later, the market created another swing, another strong drop. And just before that fall, there was one small bullish candle. That's our new origin candle. So we mark its high and low, extend the zone forward, and wait for price to return again. The entry logic stays the same. Wait for price to return, look for confirmation candle. Place your stop loss above the zone and set your target based on previous lows, ideally a 1 to 3 or 1 to 5 risk-reward setup. Let's flip the chart and talk about the demand zone, the area where institutions place aggressive buy orders. Most retail traders think demand is just any level where price bounced before, but real demand is not just a bounce. It is where the market reversed with power because big money stepped in to buy. A strong demand zone creates a sharp V-shaped reversal, not slow choppy candles. If price ranges inside the zone, forms too many wicks, or comes back again and again, the zone is weak. Strong demand equals aggressive move plus clean structure break. Weak demand equals slow move. Too many retests, no real volume. So here's the rule. Take the high and the low of the last bearish candle before the impulsive move, and that becomes your demand zone. Mark it, extend it forward, and wait for price to come back. Because remember, institutions don't always get all their orders filled in one move. So when price returns to that zone, those unfilled buy orders get activated again, and that's where we enter. Same rule as supply. The move must break structure. If price goes up but doesn't break a previous high, it's not a real demand zone. It's just a pullback. Only mark a demand zone if the bullish move breaks the previous swing high. Break of structure equals confirmation that institutions were actually involved. Once price returns to the zone, look for confirmation, liquidity sweep, rejection wick, engulfing candle, imbalance fill, whatever fits your entry model. Stop loss goes below the demand zone. Targets, previous high, imbalance above, or 1 to 3 to 1 to 5 RR depending on the move. Now that you understand how to draw zones, let's talk about something that separates average traders from smart traders, because anyone can draw rectangles on a chart, but only few know which zones are worth trusting. The first thing you need to check is how the price approaches your demand zone. If the price is coming slowly and gradually into the zone, that's a good sign. It means the market is absorbing liquidity and preparing for a reaction. But if the price is aggressively falling straight into the zone, avoid entering, because in that case, buyers don't even get time to defend that level, and the probability of reversal drops significantly. So remember, slow approach, stronger bounce. Fast approach, weaker reaction. Now, this one is a game changer. If you spot a fair value gap, FVG, connected to your zone candle, that's a strong confirmation. For example, after your zone candle, if price shoots up very fast and creates an imbalance, that's exactly what we want. It shows institutional activity and gives your zone more power. Because when price later returns to fill that gap and tap into your zone, it often gives a high probability entry setup. But if price just slowly creeps back with small candles and no imbalance, it might still work, but it's not a high-quality zone. So your best setups are always when a clean zone is backed by a clear imbalance. Once price touches your zone, don't jump in blindly. Wait for confirmation, like a rejection wick, engulfing candle, or strong reversal pattern on lower time frame. That's where your low-risk, high-reward trade begins.